First, I'd like to say thank you to Dr. Lieber and ACATIS for welcoming me so warmly. It's been a great day today. I know I've learned a lot and have a lot of new research ideas to go home and start to study. So a wonderful day. And I'm also fortunate to be the one that's between you, drinks and a lovely art reception and dinner. So I will try and keep you engaged as best I can as we go through the presentation. Some background, my name is Jamie Wise. I'm the CEO of BUZZ Indexes and Periscope Capital. Periscope Capital is a Toronto-based hedge fund. We launched in 2009, and for over 5 years now, we've been studying investor sentiment from a non-traditional lens using natural language processing and various other techniques to extract insights from ever-growing online data sets. This is a great quote that I think I can now change in the presentation with some of the comments from Dr. Lieber, but it gives you a good sense of really why we're all here today. The future is now. This is a quote from Jeff Tarrant, who is the founder of Move37. They do a lot of investing in AI-based initiatives as well, and Wired magazine calls these types of techniques the third wave of investing. And indeed, there's discussion around, is it going to be fully autonomous, or is there room for man and machine? My view is that there's really room for both in the marketplace. AI is a tool that we just heard of, and that's a very important thing. AI is a tool, and it's a tool that can both complement human managers or come up with new innovative product strategies on their own. So what brought us here, and why can we now use some of these tools to extract new insights from data sets? And as we go through the first part of the presentation, I'm going to speak generally around how AI is used in investing today, and then we'll speak more specifically around what we do with respect to sentiment. But we all know this. There's been huge growth in data, right? And data coming from all types of places. And what our job is in the asset management industry is to look at that data and try and determine, are there new ways of applying it to the research process? Is there new insights that we can uncover from this data? And the combination of these growing data sets and technological advances, so think about GPUs, being able to deploy machine learning techniques, we can actually find insights from data and help answer questions that we always wanted the answer to, but we weren't able to achieve before. Interestingly enough, from a sentiment perspective, there's a platform in the US that you may be familiar with. It's called StockTwits. It's a community forum where traders, investors go to talk about stocks. It has become the most popular forum. And just so you can get a sense of the growth in data and the data on that platform, they have 1.5 million registered users, 500,000 active monthly users that generate 35 million unique messages per month. That's a lot of data, and that covers over 11,000 securities. So you start to get a sense of, while there's a big digital trail out there of information, certainly there has to be some value within that information, and we need machines to help us extract that value. Of course, the financial press has been discussing the concept of data and how more asset managers are using this in their investment process. That's nothing new. You likely see this every day if you're opening a newspaper or reading a story online. And the largest asset managers in the world have also taken note. So they are publishing research reports and white papers that really detail the process of how different sort of parts of the research process can be affected by this data, different tools to use. The JP Morgan report here in the middle, this is about, I don't know, 140 or so pages. So if you have a flight to take somewhere, it's a great reading material, and I encourage you to track it down. When we talk about this growing amount of data, there's really 3 categories that it can fall into. There's peer-to-peer data, there's business processes, and then there's sensory type data. These are the new data sets that investment managers are looking to for insight and maybe some predictive value with respect to stock price returns and other asset classes. At BUZZ, we focus just on this peer-to-peer section. So that would include things like social platforms, like StockTwits that I just mentioned, news sites and forums, Seeking Alpha, Twitter, obviously, and any other data that we can find online. And you can do a lot of crawling and searching for these different types of sites that people are engaged on and talking about stocks in their investment portfolio. That's our focus for 5 years. But when you hear about alternative data, you'll also hear about business-related data, so transactional data, credit card information, mortgage defaults, or more structured data. So peer-to-peer and online data is very unstructured. You have to make sense of it, but you now have access to, full histories of corporate filings and corporate reporting, government issues, data that really analysts used to read by themselves and try and process, but now you can train machines to look back through history and try and make sense of that data. And we heard about that earlier today with respect to compensation schemes. And the final category would be sensory data. So that would be satellite imagery, the classic example you've heard, counting cars in a parking lot. Not sure that's the best approach as we move to an online world, but understanding, shipping movements and shipping trends and when tankers are turning around and how full are the oil storage units and all of these information points that we can receive and study from these new data sets. And smartphone tracking, where are people moving and why, and how does that affect or sort of correlate to maybe asset price returns. All of those things are being studied and studied right now today, so the future is now. And how do we accomplish all this? From what I mentioned earlier, using machine learning techniques and deep learning techniques, all falling under this general artificial intelligence concept, but really needing much more horsepower in the computing to be able to make sense of that data and then find new relationships within it. If there was one slide that I would ask you to focus on and a takeaway for today, this would be it. This is sort of my view on the state of artificial intelligence in the world and the state of it with respect to the asset management community. The first concept of general artificial intelligence is maybe what you'd hear about when you hear a fear-mongering type story online about how artificial intelligence is going to take over the world and be able to make better decisions at us in every aspect of our lives, and we'll just all lose our jobs and have nothing to do anymore. That's really not the case of where we are today. Artificial intelligence today is task-specific. So think about things like image recognition or self-driving cars or language translation. All those types of processes that have been improved through the use of artificial intelligence are really only capable of doing it on one specific task. Your language translator cannot recognize a picture of a cat, and that image recognition tool can also not drive your car or make you toast in the morning. So we can achieve very high accuracy rates on very clearly defined tasks, but the concept of a general AI is sort of far from reality. As it applies to the investment management process, again, general AI is what you may hear about when we say we're going to try and put every type of data set that we can find into a machine and look for some correlation, and out will come a magic portfolio that will absolutely beat every manager on the planet. That's not the case. We need to be much more task-specific in our application of AI with investing. We need to define a problem set or a question that we want answered, and then ask ourselves the next question: is there data that can actually help us find that answer? And if there is, what kind of tools do we use, and how do we train those tools to specifically answer that one task? So that's a very key differentiation. Of course, early adopters trying to use this technology, like most things, starts in the hedge fund world, ourselves included. Just being smaller firms, being able to access technology, we can sort of start thinking about this. But certainly, people are catching up. And two firms that I know, interestingly, I'm from Toronto, but both are outside of Canada. One obviously is ACATIS, the other is Sanlam, who's South African-based, are really more traditional asset managers who have become more forward-thinking and using and thinking about how to apply these technologies and how to build more interesting portfolios and really be able to process more research and more information into their products. Within the ETF space in the public markets in North America, there are now 12 separate ETFs that say they use some form of artificial intelligence. The index that we created was the first one to come to market. That was back in April 2016. That trades in New York under the symbol BUZZ, and we licensed that index to a firm named Alps there. And then since then, we've seen other approaches to AI come to the market. AIEQ was the next, and then a Canadian firm, actually, 2 Canadian firms, Bristolgate and Horizons, both brought rather opaque type structures. These would be structures that I would consider to be more general AI. We're just looking for relationships in data, in market price returns, in stock price returns, to try and build portfolios out of correlations that we couldn't observe through more traditional quantitative modeling techniques. We hear a lot about this word clustering in terms of grouping security behaviors or other things together, and that machines can do a good job of doing that. It's actually applicable now in what BlackRock's doing with their new clustered sector-focused funds, and it's applicable because, as you may be aware, companies like Google are no longer going to be considered tech companies very soon, right? So the GICS classification for Google is going to move it from a tech company to a communications company, right? And so when we think about in a traditional portfolio management sense, well, what is my tech exposure? And if you're comfortable with it, and all of a sudden Google just gets reclassified along with a bunch of other tech companies into communications companies, does that mean you need to rebalance your portfolio or not? Or should you be thinking about the way securities behave in a different approach than just a more classical classification system that a group has come together to decide where it belongs? So that's what BlackRock is trying to do with their funds. For this part of the presentation, I'm going to move into the discussion on sentiment and why we became interested on sentiment and how we approach that problem. So for me, being in the hedge fund business and having a background in equity derivatives and trading generally, I've always been fascinated in sentiment. And I think intuitively as investors, we all understand that sentiment plays a role in stock price performance, in setting returns, and whether a company will trade at 10 times earnings or 15 times earnings. The problem that we've had traditionally in this business is measuring sentiment. How do you measure sentiment? So we have relied on proxies where we follow the VIX. We can rely on put-call ratios. We listen to expert opinions on television that tell us sentiment is high or low. And in fact, we've often been told that sentiment is some form of contrarian indicator. Well, we know that's not true, because if it was perfectly a contrarian indicator, it would be very easily to just take the other side of all of these sentiment comments and make money. So we know that sentiment has some predictive capabilities. We know that academia has done a lot of research talking about how sentiment can actually be a precursor to performance, but we've never had a way of measuring it. So what I found when we first started our research into this was there was an early paper that was looking at chat rooms back then. This would have been before StockTwits, before really people took to Twitter, but trying to identify from those early chat rooms you could mine for sentiment. And what I believe to be the future would be that people would come to engage online about their investment portfolios and stocks the same way they had become comfortable doing around all aspects of their social lives, not only just about their social and friends and family, but about their experiences with consumer products, their experiences with vacations and restaurants, and all of those things that people became comfortable talking about and looking for engagement and looking for broader feedback. That would happen with respect to their investments too. And if it did, wouldn't it be wonderful to know or have insight from the consensus view of that conversation to be able to identify which stocks collectively people were most positive towards, and could that be predictive of future price returns? So how do you do that? How do you actually build a model to process all of this information? This is a general overview of our models, but I would say that one thing that's important, and we heard it earlier in a presentation today, is labeling the training set for your models appropriately. And so we heard earlier on that someone outsourced the ability to label when the chickens were eating the food, right? We can't do that with respect to stock-specific conversations, because you need to understand how people talk about stocks to understand if sentiment is positive or negative. So I would offer to you that probably everyone in this room, if I presented to you, a bunch of tweets or posts or messages around stocks, you could very easily classify that because of your experience in the financial markets. But if you were inexperienced in financial markets, didn't understand the phrases and acronyms that people typically use when they talk about stocks, you would do a very poor job of accurately measuring sentiment. And so the same applies for sentiment-related models. There are many models out there that try and understand individual preferences or behaviors around different consumer products or Amazon product reviews, TripAdvisor reviews, those types of things. It's not as simple as just taking that model and then pointing it to a conversation around stocks and expecting the same level of accuracy when scoring sentiment because it's done differently. So where we've been fortunate is from two regards, actually. First, we have that in-house expertise. We actually have to sit down and score thousands and thousands of messages and posts, but we do that to complement a broader set of pre-scored data. And on platforms like StockTwits, users actually have the ability to flag their comments as either bullish or bearish when they make the post. And that has actually served us very well because with 35 million posts per month, on average, it's about 25 to 30% of users will flag their posts as either positive or negative. We have an enormous training set that we can use to help train our models. And then from our in-house team, we can actually further classify the model from a 2-class model of bullish or bearish to a 3-class model of positive, neutral, or negative, and we can then tweak and better train the models based on our own expertise. So in-house ability to build and train models is very important if the goal, which was our goal of our research group, to as accurately as possible measure sentiment around this vast conversation of stocks. So this is how the model looks at graphically, visually. We take in all of these people that are talking about all of the stocks, large cap US equities that you can imagine. It comes from across the online universe, passes through the model, and then we're going to discuss now how we actually end up with our sentiment leaders index, the process behind it, and how that has actually just recently been licensed now to ACATIS and available to the German market and Europe generally. So the BUZZ index, and what do we focus on? First, we focus on large cap US equities, and it holds on a monthly basis the 75 large cap US equities that exhibit the highest degree of positive investor sentiment. We cap the weightings of those 75 stocks with a maximum weight of 3%, and we weight the index based on individual stocks' relative sentiment strength. So the higher the positive sentiment, the greater and the higher the weight that it will receive in the model. It rebalances monthly, and this is another important concept to think about when you think of sentiment, is do we want to measure sentiment on a minute-by-minute basis? Do we care on an hourly basis, daily? Right? We know that there's going to be a lot of volatility in short-term sentiment. We can get a celebrity on TV that says something about a stock or a research analyst that can cause a short-term blip in sentiment. And as an investment strategy, that would be very difficult to employ unless you were a high-frequency trading firm trying to capture that minute-by-minute action. Our view is that sentiment is a factor much like value, growth, momentum, size, geography. Sentiment is something that has always been around. Now we can measure it, and there is a way of consistently maintaining exposure to positive sentiment by thinking about it over a longer time period. So our approach is to think about really like monthly sentiment, monthly average aggregate sentiment on these stocks, and identify trends in momentum of that sentiment, much like a wave would build through an ocean, and that wave would have that momentum to carry it forward and not just stop and reverse course on a dime. So that's how we think about sentiment on that longer term basis, and that's why we're able to rebalance the index on a monthly level, monthly basis in keeping with that view of sentiment. Now, does it work? Well, in a word, yes, it does. And this is part backtest and part reality. So we can't test our strategy going back any farther than 2013 because there simply wasn't enough conversation. An important feature of our approach is that we only care about those large cap US equities that exhibit a consistency, diversity, and a lot of breadth within the conversation over a one-year period. So there are, 7,000 US equities that people can be talking about at any one time. There's probably a couple thousand of those that fit in the large cap universe. But then from those, it makes a big difference if you have 50 people talking about a stock versus 50,000. And it also makes a big difference if there's consistency to that conversation. Having consistency to the conversation gives you much more confidence in the predictive nature of changes of sentiment within the tone of that conversation. So if a stock just has a huge spike in conversation because a pharmaceutical company had a big FDA approval or something like that, and then that conversation dies down, that is not enough for us to get comfort that it's really representative of the investment community. When we first started, of the large cap US equities that exhibited these characteristics of breadth and diversity within the conversation, only about 150 or so met that threshold. Today, that number is 350, and that's a testament to how much the conversation is growing online and how many more stocks we have to choose from as part of the index creation process. So this is the back test going from now all the way back to 2013. But in a live environment, since April 2016 and in the last year, you can really see the outperformance continuing to grow. This is over the last 12 months relative to the S&P Total Return Index. BUZZ has beaten it by 12%. On a year-to-date basis, nearly 9%. So what we find is, as we get more data and as the models are able to understand and score that data with accuracy, we have a greater pool of stocks to choose from, which allows us to choose the right stocks, positioning it to outperform as best it can. And let's look at a couple of examples. Here's one that you may be familiar with that actually has, in the financial press and in the analyst community, probably a lot less conviction than it does in the broader community of investors, at least from what we observe. This is shares of Square, the payment processing company. You may be familiar with it. And it has been on a terrific ride with volatility over, I think that's since January 2017. And interestingly for us, it first appeared in our index in January, and then it was out. But a few months later, it was back, and it's never left. And even though throughout this whole time we would see, an analyst downgrade the stock on valuation concerns, we would see short sellers, publish research reports on the stock, even during these periods where it would spike and fall down, sentiment remained notably positive throughout that whole period. So every time we would see a dip in the stock, we would not see any dips in sentiment. That to us was a really clear indicator of its likeliness to rebound and keep marching higher, which in fact it has. Here, I have to thank Mr. Lannemeyer for his earlier comments, because I don't need to explain to you what Kite Pharmaceuticals is. I don't need to explain to you what CAR-T therapy is. But what I can explain to you is that in May of 2017, we picked up investor sentiment becoming notably positive, and really for all of the same reasons that we heard in the earlier presentation, right? Investors were becoming excited at the prospects of these types of therapies. Kite Pharmaceuticals was right in the middle of it, and lo and behold, 3 months later, the stock gets taken over. So it's not just technology names that people are talking about. Now, large cap US equities, the bigger the company, the more widely held the company, the more likely it is to be talked about across online communities, pharmaceutical companies being one of them, even consumer indices. So here is shares of Wynn Resorts. First came into the index in March of 2017, actually left the index after a really good run, but it didn't take long for sentiment to allow it to be part of the overall index just a few short months later. It's still in there now, and I need to update this chart. I think the stock's trading around 190 last I looked. So another good contributor to performance, but not always going one way. Here's Take-Two, another example where it's catching that momentum on the way up, people becoming really excited about the prospects of this company, runs up. Actually, within a few months, sentiment started to wane, probably on valuation concerns, and it's no longer a part of our index. So we do see this active rebalancing in the BUZZ index. Typically, on a monthly basis, we'll see between 8 and 25 names completely change over. As the universe of eligible names has grown to 350, turnover naturally within the index has grown. But what we can say is we always hold the most positive names in the index, and the average holding period over time has been 6 months. More recently, it's probably been a little bit less. So how does it all work? Where does all this buzz come from? So I mentioned StockTwits as a platform earlier. Twitter actually has more in terms of volume of conversation than even StockTwits. It's noisier, as you can imagine. And then we look anywhere online where people are talking about stocks. That could be longer form text like Seeking Alpha, news sites, comment sections to news articles, Yahoo Finance, anywhere where people are aggregating and commenting on stocks, we can find it. Twitter's actually a great tool for that because a lot lot of people will actually use Twitter as sort of an announcement for their blog or their discussion posts, and they'll tweet about it, and then you can trace through the links of Twitter to find even more conversation. And then we say, you know, what are people saying in aggregate? And on a tweet-by-tweet, message-by-message, article-by-article basis, we can identify through our models which ones are positive, which ones are neutral, which ones are negative, and then we aggregate that information to come up on a daily basis with an overall score for each stock. Here, this is an important thing to talk about. Who is creating the buzz? Does influence matter? These are theoretical questions that we spend a lot of time thinking about. And actually, in an earlier presentation, we just heard before, you know, you throw the glass of water on the wall and you have a big reaction, then you throw your watch through the screen, your reaction changes because humans become conditioned to expect things quickly. We actually have a different phrase for that. We call that diminishing return of influence, and we think that applies to Carl Icahn and the president, right? The first time Carl Icahn tweeted about Apple, it was a really big deal. It moved the stock. There was a lot of coverage on it and from the financial press. People were shocked that he would even use Twitter to talk about stocks. Was that allowed from a regulatory perspective, right? It got a lot of buzz. But now it happens so often that we're not surprised to see it. And in fact, we are unlikely to act on it, right? It's unlikely to influence our behavior. What it does serve is as a great catalyst for conversation. So if Donald Trump or Carl Icahn or any other celebrity, I would call them as opposed to influencer, mentions a stock in a tweet or a post or an interview even, what happens in the online community is it becomes a catalyst for a broader discussion. And thousands of people will now go online and talk and share their views about that stock, whether they're buying it or selling it and why. And so that's where the value, the real value of those types of posts matter to us. The other concept to think about, and we think about this a lot, is, you know, what does it mean to be influential? Do you have to be contrarian to be influential or not, right? So if we're all positive about a stock and some celebrity then also comes out with a positive comment, is that influence or not? Right? And how much does it have to change the overall score of sentiment to be determined influential or not? Do you need to be able to sway people the other way? Our view is that it's less important than you think, and that the size and scale of the larger data set matter far more than any one individual. Where influence does matter to us is if you're new to social platforms, right? So there's going to be someone new comes onto an online community and starts talking about a stock for the first time. Is that person a real human being? We don't know much about them at that point. We know their username, and we probably know how many people they're following. They likely don't have any followers. But are they broadcasting, over time, are they broadcasting original content, or are they only reposting other people's comments? Are they posting a lot, 100 messages a day, or are they only posting 1 message a day? If you're posting or rebroadcasting 100 messages a day, you're likely not a human being. And so we can eliminate the sentiment from those types of posts that we observe online from the overall score. So it's more important to the downside than to the upside for us. And, well, how do we think of sentiment? Again, to us, sentiment is a factor that's always been a part of markets and has always existed from the first day a stock traded on the New York Stock Exchange 200 years ago. Individual traders' conversations influence that stock price, right? We all can feel that. Now that we can measure it, we can identify this new factor. We'll call it sentiment momentum, which is different than price momentum, by the way. So price momentum, people will think, well, if you're positive sentiment, these are all high momentum stocks. It's not the case. If you think, why would people be talking positively about the stock? There's 2 reasons. Either it's from an alpha perspective, moving like that on the chart, and people expect those gains to continue. That would be more of a classic momentum. Or it's doing this, and it's falling to a point where it now represents value. It's cheap. The prospects of the company are about to turn. All of those reasons why people might become excited about a stock and talk positively about it. So you end up with really a portfolio that's not all high growth, high alpha stocks. You end up with this kind of barbell portfolio that has stocks that exhibit both types of characteristics, but the one common theme that they all share is that they all exhibit positive investor sentiment. Sector allocations are a byproduct of our process, so we don't constrain the output in any way. When we create the index, the idea is to show that sentiment and sentiment alone can deliver a portfolio of recognizable large-cap U.S. equity names in a manner that's different than traditional market cap-based approaches or value or growth or other factor approaches, and actually can add alpha by doing that. So we don't constrain sectors, because if we did, then you would have to do a performance attribution, how much of your sector constraint really added to the performance relative to everything else. Plus, we think it's important that if people are more positively predisposed to healthcare, tech, and consumer sectors, that should be represented in the index. That's the whole point of the index. And if market dynamics change and people's sentiments change, that should be reflected as well. And here's a couple of interesting charts that just sort of highlight what I was saying about overlapping to traditional strategies. So if we look at the index and then we look at how much overlap is there to the market cap S&P or value or momentum type strategies, there really isn't much overlap at all. So it really is producing a unique set of large cap US equity portfolios. And most interestingly, if you own the S&P 500, if you own just a large cap US equity universe, you're going to own a fairly normal distribution of sentiment. You're going to own stocks people like and stocks people don't like and all the stuff in the middle. But by focusing on BUZZ, you can really get that concentrated sentiment exposure. Here, transparency to us is very important. On our website, we publish the daily holdings of the index every single day. So here is I think as of the last rebalance, in May of just a few days ago, we rebalanced the index. On rebalance date, this was the composition of the index. These names will stay in the index until June. And here you can see the sector distribution. Tech, consumer, and healthcare typically, at least over the last 2 years, have made up the 3 largest components of the index. We've seen materials, which are right now at 0%, be as high as 8 or 9%. Same goes with financials. We've seen low double digits and almost 0. So we do see interesting sector shifts happening as people's sentiments change around the markets. Some fundamental data around the style of the index, but effectively large cap US equities. And that's what we do. And I'm not sure how we're doing for time, but we might be a little bit early or perfect timing to ask some questions.